Okay, so we will start talking about what is financial derivatives and what is the financial derivative trading. So, derivatives contracts are commonly used by the majority of the world's largest companies. So they can be better manage their risk and make their cash flow more steady and predictable. So this level of predictability in cash flow and earnings can help boost their stock price. When their price is boosted, they need less working capital. Derivatives works on a small premium, so a company need not have a large amount of cash on hand to invest. Often before the contract has expired, another contract is opened to offset the first. So what is a financial derivative? Derivatives explained. A financial derivative is a tradable product or contract that derives its value from an underlying asset. The underlying asset can be stock, currencies, commodities, indices, and even interest rates. Derivatives were originally designed to help investors eliminate exchange rate risk, but their utility has grown over the years to help investors not only mitigate various types of risk, but also access more market opportunities. Derivatives are now attractive to many types of investors because they help them to remain exposed to price change of different financial assets without actually owning them. So, type of derivatives. The most common types of derivatives contracts are futures, options, and CFDs. These are offered either OTC, over the counter, or via an exchange. The derivative's value is affected by the performance of the underlying asset and also the contract conditions. The more common derivatives used in online trading are CFDs. So CFDs enable you to speculate on the increase or decrease in the price of global instruments like shares, currencies, indices, and commodities. When you trade CFDs, you are effectively taking a contract rather than taking hold of the underlying asset. That means you will be speculating on the price movement rather than buying the actual asset. So with CFDs, you can trade both ways, on both rising or falling markets. That is a big benefit of trading CFDs rather than buying stocks, for instance. Future contracts. This is often used for commodities, shares or currencies to offset risk. A company that needs to receive raw materials in the future can have a reasonable price locked in. This will protect it from the future price hikes. This may also protect the company from future currency exchange rate changes or even interest rate changes. This protects against currency depreciation, especially in terms of exporting products into the local currency. Index futures like the S&P 500, E-mini futures ES, and also currencies take on board current investor sentiment in order to reflect that into the future pricing. Taking on board interest rates, the pricing of these contracts also changes based on the current supply and demand of the underlying asset and of the contracts themselves. They can be offset or liquidated before expiry. Futures are standardized to facilitate trading on the futures exchange such as NYMEX exchange for gold. Options. Options, trading options on derivative markets, give traders the right to buy, call, or sell put an underlying asset at a specified price, on or before a certain date. The holder has no obligation to buy the underlying asset. This is the main difference between options and futures. So future versus options. The purpose of both futures and options is to allow people to lock in price in advance before the actual trade. This enables traders to protect themselves from the risk of unfavorable price changes. However, with future contracts, the buyers are obligated to pay the amount specified at the agreed price when the due date arrives. With options, the buyer can decide to back out of the contract. This is a major difference between the two securities. Also, most future markets are liquid, creating narrow bid-ask spreads, while options do not always have sufficient liquidity, especially for options that will not expire well into the future. Futures provide greater stability for traders, but they are also more rigid. Options provide less stability, but they are also a lot less rigid. So if you would like to have the option to back out of the trade, you should consider options. If not, then you should consider futures. So you have these two to choose in between. You have the futures and you have the options. So as we said here, let's go back to this, that the future contract, it's used for commodities, shares and currencies, and it's always to offset risk. So mostly companies that need to receive raw materials in the future can have a reasonable price locked in. So we always guarantee this price. This is the future. We guarantee the price. This will protect us from future price hikes. So if the price goes up, I at least guarantee the price that I want. And it will also protect the company from future currency exchange rate. So this is important to keep things constant and to lower the risk and not make us reach places we don't want to. And options here, as we were saying, give traders the right to buy, as we said, or sell. It's an underlying asset at a specified price. So here's the domain, as we said. There has no obligation to buy the underlying asset. This is the main difference between options and future. The holder has no obligation to buy the underlying asset. So forward contracts, financial instruments that are set up with more of an informal agreement and traded through a broker that offers traders the opportunity to buy and sell specific assets, such as currencies. Here too, a price is set and paid for a future date. This contract can also be renegotiated, so extended or closed early for a premium. So we know what does swap mean. Swap is a word that is known in trading. We all are exposed to swaps. Swaps are imposed by the banks. This is normal. Trading is a business. And swaps are customized OTC contracts between two traders. These aren't usually traded by retail investors and are not traded over exchanges. A common example of a swap is on interest rate. Swaps are when two parties exchange cash flow or liabilities for two different securities over a set period of time. So why trade financial derivatives? Derivatives can serve many important functions in a portfolio. The first reason to trade derivatives is that they provide the perfect platform of speculating on the price changes of various financial assets. Derivatives allow investors to access markets and opportunities that they could otherwise not have been exposed to. For instance, one is able to invest in Bitcoin without understanding all the technicalities of buying and securing the digital coin in online or offline wallets. So you have to be aware. You have to calculate everything. You have to see what you're doing. You have to know what you're doing at least. You have to be aware. It's not an easy step. It's not something that's yeah, let's do it, let's do it, let's do it. This is not how it works out. So if an investor buys a Bitcoin derivative, they will earn profits when the price of Bitcoin rises without actually owning the digital currency. Investors also trade derivatives to access leverage. As we all know, leverage is something that investors use to boost their capital holdings in the market, effectively amplifying the profits on successful trades. But traders should always use leverage carefully because it auto magnifies losses on trades that do not go in your favor. So as we know, leverage is very important. As much as it's important, as much as it can be harmful, leverage is something landed by the broker in which it allows you to open more trades, to gives you more loan from its side. So the structure of derivatives as well as the availability of leverage can also help investors to take advantage of arbitrage opportunities in the market. Although uncommon nowadays, arbitrage opportunities arise due to market inefficiencies, such as a similar financial asset being priced differently on different platforms at the same time. And another important reason to trade derivatives is to hedge risk exposure in the market. This is done by purchasing a derivative that moves in the opposite direction of an asset you own. So it's always the opposite way when you buy something. And for instance, if an investor owns Microsoft shares, they can buy certain type of derivative based on Microsoft share price. In this case, a put option that earns profit when the price of the stock falls. In this way, the investor would have mitigated the risk of holding the stock when its prices are not appreciating. So now let's talk about the advantages of derivatives. So as tradable products, derivatives allow investors to have potentially lucrative additions to their investment portfolios. They are leveraged products that can help investors spread their capital efficiently in the market and earn boosted profits, although the risks are also increased due to the leverage exposure. Derivatives have also opened up opportunities for the leveraged retail investor who can now access markets such as global equities, forex, bonds, commodities, and even cryptocurrencies with low fees. These are markets that would traditionally require a huge amount of capital and sometimes even a great deal of expertise. So derivatives are also used for mitigating risk in the market. They are perfect for hedging strategies and can help investors to offset any risk or potential losses in their portfolios. Because they are leveraged products, derivatives provide a cheap and effective way to hedge against any risk in the market. Leverage also allows investors to use derivatives to earn profits out of marginal price and changes in an underlying asset. Because leverage enhances capital, even a fractional price can change in the market can lead to big profits or heavy losses for an investor. So for this reason, derivatives can be used to trade financial assets even during periods of low volatility or relative price stability. So what are the disadvantages of derivatives? Leverage is one of the reasons that make derivatives appealing to investors, but it's also the biggest source of risk. In the same way that leverage can boost profits, it can also magnify losses when the prices of the underlying asset do not go according to your prediction. This makes derivatives particularly risky for trading underlying assets whose prices are inherently volatile. Derivatives can be difficult to value, especially those that are based on multiple underlying assets. This can make them a tool for gambling rather than effective investor speculation. In derivatives, money is made out of price change, and not knowing how to price an asset accordingly could expose an investor to higher than normal risk. Some derivatives, such as options, are time restricted. This adds another layer of risk when trading a financial asset. It is realistic for an investor to predict that the price of an underlying asset can rise or fall, but it is far more challenging to predict when exactly such a price change will occur.